Morning, guys, and welcome to your market report for this Friday, November 30th, 2018. Now, I want to talk to you about something very important. I'm going to go through the markets real quick right now, and then I want to talk about Deutsche Bank. So let's get started. Let's open up the charts right here, and the first thing we're going to take a look at is cryptocurrency, and we're going to go to Bitcoin Wisdom. And it's doing exactly like I said. I figured it was going to drop off. And the next part is make new bottoms, make new lows. That's the next part. That's what I figured is coming. Now, I called that bounce. It went up to $4,300. It went up roughly, well, let's see. Let's take a look at the charts a little bit closer here. And it went from a low of 34.74 up to 44.09. So roughly $1,000 raise in price. Now it's dropping down now, and it's heading down to make a new low. And so I'm not exactly sure how low that low will be, but I'm planning on catching a falling knife and buying a little bit in as it's falling here. The price I plan on buying in is going to be probably around 3,200, and see if I can get a little bit more cryptocurrency. Now let's take a look at cryptocurrency market capitalizations today, and everything's falling like a stone right now. We're looking at a market cap of $130 billion, 53.7% Bitcoin dominance, and all the coins are falling like a stone. What I see this as is depends on how far they fall, but if they keep falling like this, it's going to create some fantastic buying opportunities in these cryptocurrencies. Take a look at the silver price today. Silver price doing exactly the same thing. And I'm going to tell you, it's going to create just as good and just as great a buying opportunity if it continues to fall like this. It's falling like a stone today. Honest to gosh, look at this. It's down 22 cents on the day. That's a lot considering how cheap silver is right now. You take 22 cents off the price and you're looking at 1.58% today alone. On probably, well, they don't call them precious metals for nothing. Let's take a look at gold, the other precious metal, and see if it's falling like a stone too. Yeah, $6.70, and it's just sliding right down there. It's at 12.1720 today, and that's great. Sliding right down. You catch a piece of some of these. Even if you catch a falling knife and it goes down lower, if you can HODL gold and silver too. You know, people are forgetting that fact that you can HODL gold and silver. You know, they call them stackers, and they've been around longer than these HODLers, you know, the stackers. And that's what they do. That's their business, is HODL, and it looks like they're going to get some fantastic bargains coming up. Great for stacking, you know. It's stacking season, guys. It's stacking season. That price keeps coming down. Let's take a look now at the Dow Jones Industrial Average today. Let's see, is she open yet? Yeah, and let me see what we got going. It says market open, 35 points up. Oh, no, down, 35 points down. I'll tell you, the Dow Jones, you know, this is pivotal. We got to go back to really know what's going on. Got to go back to the max chart here. Let's see, and what you see is it's a constant run up. This max chart goes all the way back over the years, and you see a constant run up here, except for this right here. That's what you ask you, what looks out of place? Well, the 2008 event leading into 2009. That's what looks out of place on this chart. But the biggest run up of all was what happened after 2008 to 2009. This huge run up here. Now here we are here. We're perched at the top of this diving board. From this huge run-up, and this huge run-up was caused by quantitative easing. Now, if you look closely at this huge run-up, let's be myopic. Let's pull the charts in here and take a close look at this run-up. And I'm going to point out a couple little details here real quick that people might not notice before. This was a run-up that was caused by easy money from the Fed. Okay? Now, in this run-up, what you'll notice is there is a few times it slid down, it fell. Okay? There's several times here it fell a little bit. Each time it fell was when they ended one program of quantitative easing. And there was a little delay before they entered into the next program. So when they ended quantitative easing 1, and they come out with the next quantitative easing, there was quantitative easing 1, quantitative easing 2, there was Operation Twist, and there was quantitative easing 3. And each time they started a new program here, that's when the market started to go back up again. It's just like pumping drugs into a drug patient or something. The money that they were pumping into the system, and that's what pumped the stock markets up. Well, they're reversing all of that now. So what do you think is going to happen? And it's amazing that the stock market's been able to hold this height with money being drained out instead of money being pumped in. But, you know, eventually it's going to roll over and fall. It's reached that point where I think it's ready. It's really ripe and ready. Okay, so let's take a look now at oil prices. Oil prices are sliding again today. $50.20. They're down $1.25 on the day. That's 2.43%. That's quite a big drop, you know, right there, just today alone. But look at what they've been doing ever since it all started back on October 3rd, I guess. That's when the oil price started to fall, and it's just been a slaughter ever since. This doesn't stop; it continues falling. I mean, I like to see it, and I go to the pumps and I see a few pennies down each time, you know, per liter. We buy it by the liter, by the way, instead of the gallon. And that's their way of chiseling us. That's their way of making us pay more, because they divide it into smaller units, and then when they raise the price of those units 1 penny, instead of 1 penny, it equals 4, because there's 4 liters, basically, roughly, to a gallon. So because we're buying it by the liter or smaller amount, when they raise it a penny, when they raise us 1 penny, it's equal to raising it 4 pennies per gallon, see? And that way, they're able to chisel us easier. I mean, the smaller unit they would sell gasoline by, and if they raised it a penny, the more they're actually raising it, but it makes it seem like they're not really raising it very much, see? And so it's the same thing as shrinkflation, when they shrink all your products, and then they tell you you're getting the same price for the product, but you're only getting 20% less. You know, it's the same deal. It's chiseling. They're looking for every angle that they can find to cheat the consumer. Basically what it amounts to. They put gasoline taxes in, for crying out loud, you know, and they say, okay, we're going to repair your roads with these gasoline taxes, and then you never see the roads repaired. After a couple of years goes by, and I think you forget about what they said they were going to do with the money, I should say. Then what they do is, then they come along and tell you they need more money for road repairs. I mean, they're just constantly figuring out ways to take the money out of the pockets of the middle-class people. It's sickening. These guys need something, some hand that's going to come and stop them, because the people aren't doing it. The people aren't stopping them. They need something that's going to stop them. If they don't, they're just going to continue to get worse and worse and worse, chiseling us until in the end we don't have we don't have anything to even feed ourselves with. And they'll be sitting at richer and richer and richer. They're just getting richer and richer. Okay, here's bonds. Bond yields today. We're looking at the 10-year at 3.011%. These bond yields have been falling, you know. And look, today the short end of the curve is rising. That's a flattening curve, and flattening fast if it continues to do that, you know. The short end rising and the long end falling, that's going to flatten the curve. Anyway, let's take a look here at the U.S. dollar index, and we're looking at strength in the dollar today. She's up to 97.09. She's taken off. That's because there's no real competition for the dollar. Cryptocurrencies could have been a contender. You know, seriously. If they can get their act together and get up there into maybe a couple $1 trillion worth of market capital, and investors start to look at them seriously, they could be a contender. But they've dropped back now. They've crawled out of the ring, and they've actually left the building. Cryptocurrencies has, and dollar's the only one in there in the ring fighting it out, and it's the Royal Rumble. And for crying out loud, dollars in there against some of these other currencies, and they're not doing so good. Dollar's the best fighter in the Royal Rumble, and he's throwing everybody over the top rope at this point. And so he's charging up to a lead in the whole thing, and 97.10 for the dollar. I don't see it stopping. It's going to continue, this power in the dollar, as long as they continue with these policies, especially the Fed. And they don't intend to stop. You know what? That was all a bloomin' head fake, what was going on. That was a head fake. Deutsche Bank stock today. Let's take a look at this. Oh, this is rich. They're up to 803 right now, but look at their what's happened over the past few years. And going back, say, to 2006, look, they were up to $80, 80 euros, which was like $100, And look at the slide. Now, this is a slide that's occurred since 2006, 2007, 8, 9, 10, 11, 12, 13, 14, 15, 2000, all the way up to 2018. This slide. Do you really believe suddenly something's going to happen? A slide that's been happening for that long, just steadily down, 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 down. Do you really believe that some sort of a miracle's going to come along and bring them up and make them whole again? Who believes that? Who believes that? But here's what I want to talk about now. I'll turn the charts off. Here's what I want to talk about. The system... if Deutsche Bank goes down, and people say, oh, they're too big to fail and stuff, there's nothing that's too big. Like, take a look at the Titanic. They said the Titanic was too big to sink. It sunk. There's nothing that's too big to fail. And the system will rebound. I mean, they will get over this. And the reason why, I'll explain it to you right now. A lot of people say, well, Deutsche Bank's got a $55 trillion nominal derivatives book, and it'll take the entire world's banking system down, and we'll all go into a Mad Max world if Deutsche Bank goes down. No, it won't, and I'll explain to you why. Deutsche Bank is like a boil on a person. Now, take a look at a person's immune system. A person gets a boil in the back of the neck. How many young guys that you saw out there, like at the supermarket or something, with a boil on the back of their neck? They don't die. But it causes a big problem. It does cause a big problem. The body's immune system produces white blood cells and comes in to fight the boil. And so you see a big red splotch, about this big around, where the infection is around that area. And the body is coming in and it's cutting off the infection. Well, Deutsche Bank's a boil. That's what they are. They're a bloody boil. And here's the thing. Once they get lanced, the pus is going to come out of them. The pus is going to come from the exact point of the bank itself. The bank itself is going to be full of pus. That's got to get rid of that. And that'll go once they pop. Like pop them like a big pimple. You know what I mean? So Deutsche Bank, the rest of the body's not going to die because the central banks are going to come rushing into that situation. And wherever they see lines of problems spreading to other banks, in other words, the infection's starting to spread to other banks because they had part of Deutsche Bank's derivatives book. First off, those derivatives, the nominal values, not the actual value that they'll have to pay off. If the derivatives are counted in trillions, what they'll have to pay off will be counted in billions to complete their swindle, basically, for the central banks, to stop the contagion. Because a contagion, when Deutsche Bank goes down, a contagion will start to spread through the system, and it'll spread very quickly through the system, a contagion, from the derivatives book. And there will be banks that are all of a sudden saying, hey, you know what? We're in trouble. We're in trouble because Deutsche Bank just went down. We had a large exposure to their derivatives book, and now we're in trouble. We can't pay this. The central bank's going to come in, and they're going to make those banks whole. Okay? So it won't spread through the entire system and bring the entire system down, but it will take Deutsche Bank down, and it will cause a huge stir within the world's financial system. The problem with that is that huge stir that Deutsche Bank will create when it goes down. There's already other parts systemic failures starting to crop up within the system. Like one of the biggest problems is China. China's a massive problem, and the central banks just can't come into the rescue so easy for China. So if China starts to go down, along with Deutsche Bank going down simultaneously, what we're looking at is something that's going to be akin to the 2008 crisis. But even a little bit bigger and a little bit harder hitting. And so what it's going to do is it's going to stimulate the world's central banks into action to try to come in and solve the problem by using money creation tool. They're going to create more money into the system to stimulate the system back up into gear again. There's a few months delay from when they create that money to when that money actually starts to fall into the system, and it creates in the end, ultimately what it creates is it'll create more economic prosperity, because if they put trillions of dollars into the system, what it does is it creates new jobs and everything else. It will stimulate an economic recovery a few months after they do it. But what's that going to do? That's going to bring about the demise of the dollar. And it's also going to make people so that they're not confident in the dollar anymore. And they're going to look for an alternative to the dollar. Can we say Bitcoin, gold, and silver? But at this point right now, we're in the spot where everything is starting to shrink away, and they're all looking to the dollar. They're all heading to the dollar right now. So the dollar's riding high right now. It better enjoy its place while it's riding high. It's better enjoy that, because it's not going to last real long. But it's going to probably get a little bit worse before it gets better at this point. At this stage in the game, until this deflationary thing gets to the point where it makes the Fed relent. Now, the Fed talks a big talk about relenting, but they really don't have any plans to relent right now at all. That's just a head fake. They're faking out the markets. They got the markets to go up with this talk about dovish talk or whatever, but it's all talk. The Fed's real intentions right now is to continue to raise rates, and we'll see what their intentions are come December. Will they really raise rates? I'm betting they will, and I'm betting that they'll plan more rate hikes coming up next year, and that all this dovish talk is just talk. They're not going to really take any action, any real dovish action, until they're forced to. Then they're going to turn dovish, and when they turn dovish, that's going to be the end of the dollar. So anyway, thank you guys for listening. Like and subscribe, and we'll catch you in the next show. Bye-bye, guys.